When it comes to completely retiring off dividend income, investors are going to need a few of the following traits in their portfolio. Investors are going to need an income stream to comfortably meet and ideally exceed their living expenses alongside a substantial emergency fund to handle any unforeseen emergencies that come along with life. Now also, this income stream is going to need to be reliable through the good times and bad, because if that income stream suddenly dries up through a tough economic time, the income stream is effectively useless. Also, this income stream needs to consistently sustain its purchasing power in the face of inflation. Now, as a result, a dividend portfolio that consistently churns out higher dividends at a pace that comfortably exceeds the long-term inflation rate is needed. Well, there are two high-quality dividend-paying ETFs that not only meet all these requirements, but pass them all with flying colors. These two dividend ETFs are SCHD and DIVO. In this video, we're going to analyze both SCHD and DIVO and explain why these could both be the perfect ETFs for long-term investors to hold on to and ride out all the way throughout retirements. Now, we're going to go through all this and more right after you please drop a like in this video and subscribe for more content like this in the future. So first off, let's dig deep into the DIVO Amplified Enhanced Dividend Income ETF and see how it could be a perfect option for early retirements. So heading over to the Amplify ETF's website, it says why invest into DIVO. Income potential, comprised of high-quality dividend-oriented stocks along with covered calls on individual stocks. Active management allows the portfolio manager, the CWP, to identify opportunities and risks and act on those decisions in real time. And DIVO seeks to lower volatility. Dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. DIVO's objective and strategy. DIVO is an actively managed ETF of high-quality large-cap companies with a history of dividend growth along with a tactical cover call strategy on individual stocks. DIVO is a strategy designed to offer high levels of total return on a risk-adjusted basis, and it's done exactly that. Now, looking a little bit closer into DIVO's overall historical performance, since the fund's inception in 2016, DIVO is up around 41.58%. Now, DIVO does have an expense ratio of 0.55%, which is obviously on the higher end of some ETFs, but for an ETF with this type of strategy, it's pretty much industry standard and honestly not all that alarming. Now, DIVO does offer a well-diversified portfolio with some of the biggest and best companies in the world, and of course, on top of that, DIVO does have a cover call option strategy, which does hedge against some downside risk, but also caps a portion of the portfolio's upside potential. DIVO's holding breakdowns are healthcare at 16.99%, financials at 16.62%, consumer defensive at 14.84%, industrials at 11.54%, technology at 11.28%, energy at 10.87%, consumer cyclical at 10.37%, utilities at 3.35%, basic material at 2.13%, and communication at 2.03%. Cash and equivalents are at 11.21%. Now, DIVO's top 10 holdings are Invesco's short-term government agency at 11.02%, then Microsoft at over 5%, Visa, Procter & Gamble, Johnson & Johnson, McDonald's, United Health Group, Chevron, JP Morgan, Merck, and others. Overall, there's 35 holdings in this portfolio, so it's not the most diversified portfolio in the world, but like I said earlier, it does have some of the largest, best companies in the world as far as historical performance, and of course, has the option overlay for some extra protection. Now getting into some of the fun stuff, DIVO's dividend yields. So the trailing 12-month dividend yield has been 4.77%, and DIVO does pay around a 14-cent dividend on a monthly basis. Now, I personally love stocks and ETFs that pay out on a monthly basis because it allows me to get more cash in my portfolio quicker in order to pay for bills with the money, or of course in order to reinvest into more shares of different stocks and ETFs, which is what I'm personally doing as of right now. But looking at DIVO's history, it's paid, like I said, right around 14 cents per share or so on a monthly basis over the last several years. At times, the payouts have been a little bit higher, closer to 15-16%, but as of recent, as an investor, I'm expecting around 14 cents or so per month. Now, this of course brings up the topic and maybe the question, does DIVO have any sort of dividend growth outlook in the future? And with this type of fund, the strategy that it employs, it's not likely going to have any sort of insane dividend growth in the future unless the strategy changes from here. But as an investor, I'm not necessarily expecting to have any sort of large dividend growth. Investors are more so buying into Divo to have a consistent dividend paid on a monthly basis, and on top of that to have some decent sized overall price appreciation for the ETF price long term. Now, the last thing I want to go through when it comes to the Divo ETF is this page right from their investor guide. From their website, it says the advantages of income producing equity investments. Demand for these companies extend well beyond risk and return. Here are some additional reasons why investors continue to seek out dividend paying companies, along with investment that generate income from conservative strategy of writing call options on positions already held in the portfolio. So with this, we have predictable income. There are thousands of companies that pay monthly or quarterly dividends and may have a track record going back decades. Not every dividend payer is worth owning though, of course, but the sheer number shows that the desire for income is ongoing and has definitely been growing in the past, it seems. It also says protection against inflation. Fixed income products expose investors to interest rate risk. Fixed payments lose purchasing power in inflationary environments, but companies can increase dividends, and based on an average of all rolling 12-month periods since 1940, dividend growth has exceeded inflation by an average of 2.4% per year. So obviously it's very hard to beat inflation, but investing into certain high quality dividend payers that have a history of dividend growth can definitely help fight against it. Now also drives total return. According to the S&P Global, dividends have been responsible for 32% of the total return of the S&P 500 index since 1926. Adding a conservative covered call rating strategy overlay has helped the potential to help drive total return. And lastly, when it comes to dividends, let's talk a little bit about the tax treatment. Dividends paid by U.S. corporations or qualifying foreign equities are taxable to investors at rates ranging from, of course, 0 to 20%, rather than the investor's marginal rate, depending on taxable income. So now that we saw all that the Divo ETF has to offer, let's dig deep into the SCHD ETF and see why, in my opinion, it's also a great option for a long-term dividend growth investor to hold on to and ride long into retirement. Now, the SCHD US Dividend Equity ETF is a very straightforward ETF, and honestly, if I could only choose one dividend growth ETF for the rest of my life, it would have to be this ETF specifically. Now, SCHD has a tiny expense ratio, much cheaper than that of Divo, SCHD's expense ratio being only 0.06%. The objective of the fund is to track as closely as possible, before fees and expenses, the total return of the Dow Jones US Dividend 100 Index. Now, SCHD's highlights are a straightforward, low-cost fund offering potential tax efficiency, which we all love. The fund can serve as a part of the core or complement in a diversified portfolio, and it tracks an index focused on quality and sustainability of dividends. Now, one of my favorite things about the SCHD ETF is the basket of holdings that the ETF owns. Now, simply put, this is because all the holdings in the SCHD ETF have a few things in common. These are all companies that have a strong financial position and all pay dividends and have a past of raising dividends historically. Now, this means that in theory, the SCHD dividend is going to be continuously going up long into the future, at least if history was to repeat itself. SCHD has a trailing 12-month dividend yield of around 3.68%, which is a very decent, high starting dividend yield in my opinion, considering the dividend growth rate that SCHD has had historically. Looking back in history, SCHD has been paying around 60 to 70 cents per quarter as of the last year or so. But before that, just a few years back, SCHD was only paying around 40 cents per share. And then before that, 30 cents, 20 cents, and if you go all the way back until SCHD's inception, the fund was only paying around 10 to 20 cents per quarter. So for the investors out there, like myself specifically, that are interested in an investment vehicle that not only pays a decent starting dividend yield, but also has historically raised their dividend at a very quick rate, SCHD definitely crosses off all that. But now I want to hear from you guys down below. Now that we went over Divo and the SCHD ETF, what do you personally think about these dividend ETFs, and do you think that they're good investment vehicles for retirees? If you enjoyed this video, make sure to please drop a like in the video and subscribe for more content like this in the future. Thanks as always for stopping by, and I'll see you in the next one.